It's February 17th, 2025, and time for your Monday market update. Thanks for watching. Happy President's Day. Markets are closed, so there's no closings today. So some of our data might be a little bit skewed because of the holiday, but let's take a quick look at our McHenry County numbers for the last 7 days. We had 135 new listings hit the market. That's the most we've seen in a while, so yay, new inventory. We had 109 go under contract, 59 closed sales, 31 price changes, 2 expired, and 37 currently on the private network. So it certainly feels like we are underway with our spring market. I know that I'm lining up all of my March listings. We've got more inventory coming to the market. Very excited about that. We also have buyers that are ready to put homes under contract. So it is like full speed ahead. The interest rates are the lowest they've been since Christmas. So they're at 6.87% for the 30-year fixed mortgage rate. That's the lowest they've been, like I said, since Christmas. January 16th was the peak, when we saw 7.04%. Now, of course, that's the rate that Fannie Mae is loaning out to the bank, so that's not the rate that buyers are actually going to get, but that's still, it's a trend in the right direction. Some of that is due to poor retail data. We had the retail numbers came out last week. The core retail sales fell 0.8%. That is the lowest we've seen in 2 years. So it certainly appears that buyers and consumers out there are kind of pulling back, and they are definitely kind of saying like, we're out. We can't afford things anymore. We know that credit card debt is at an all-time high. So people are definitely struggling to afford daily necessities like groceries and gas and all those things, and it's starting to rack up. So people are starting to pull back on their spending because credit cards, you can only spend so much, and those are at a 20% interest rate. So, if you've got some credit card debt, you might want to think about a cash out refi on your home and use the equity in your home to pay off your credit cards, and then stop spending. If you can, if you're buying frivolous things, you got to reel that in. And I think some of that certainly is that. We've got $1.2 trillion in debt. That is 41% above pre-COVID levels. Now, the flip side of this is we've got an aging population. We've got baby boomers hitting that retirement age, and many of them are getting out of the workforce, which means we should see some availability for higher paying jobs, and it should give laborers a little bit more leverage to demand higher wages, because a big problem with this affordability piece that we've been talking about, my team and I dove into, why is affordability so difficult right now? Why is that the thing? And we know that it's not so much because of interest rates, because honestly, interest rates we've talked about this, they're historically average. 8% is historical average, so we're under that. So it shouldn't be the interest rates. It shouldn't be the prices, because prices are right where they should be. They're at the 4% annual appreciation. They're only slightly above that. So home prices aren't really the problem, according to the data. Interest rates are not really the problem, again, according to the data. But wages have not gone up as much as they should have. Since 1989, the average American wage has only gone up $20,000 a year. That's not enough. So that's why affordability is such a problem. So hopefully with a lot of these baby boomers aging out of these higher paying positions, we should see more availability for people to make more money and step up in those positions. So we hope that in the coming years that those trends will plan out to be in the positive direction for the middle class, so you can afford a home, because I know right now it is very difficult. Now, for this year, for 2025, we're not going to see any positive increases in that, not drastically, but hopefully we'll see interest rates continue to head into the mid sixes. That would be great. That would be a huge improvement for people, and might incentivize some of those people who are tolerating the home that they're in that maybe doesn't fit their needs anymore, and it might incentivize them to finally list that home and purchase the home that's going to fit their needs more. Because of course, we talk about why do people move? It's not because of interest rates. They move because of life events. They move because they get married, they get divorced, they have kids, they retire, they upsize, downsize, job changes. All of those things influence why people move. And all of those things have continued to happen over the last 4 years, but yet with the interest rates being higher, it's been more and more difficult for people to make those changes. So we do anticipate having a really great spring market. We are off to the races. So if you have any questions about that, please feel free to call me. I'm at 815-529-0777. Have a great day.